Hi friends, I once again welcome you all to a brand new episode of ShIvam Bajaj Finance, wherein we will talk about certain important ratios which you need to analyze and you need to understand them first to start analyzing your favorite companies which you want to invest in. So without any further ado, let's get started. So now let me take you to the screen, and first let me take you to the whiteboard and start explaining you about the topics we are going to discuss today. Okay. So I hope I am able to share the whiteboard with you. Okay. So topic number one, the first thing I'm going to share with you is the first thing I'm going to share with you is ROI. ROI or return on investment. Before telling you further about what more things we're going to discuss, let me inform you that in this video, I'm going to explain to you three important ratios which you need to consider before analyzing your companies, because they're really important and you will get to know at the end of the video why are they too important. Okay. So the first one is return on investments, or ROI, as commonly people say in the financial language. Second ratio is we're gonna discuss is gross profit margin, or gross profit ratio, as it's commonly said again. And the third and the final ratio we're gonna talk about is current ratio. Current ratio. So these are three of the topics which we are going to talk about in detail with some examples as well. So, and those examples I will try my level best to explain to you the reasons behind calculating these ratios and why are they so important. First, let us begin with ROI, our first ratio, or the first topic for the day. So, ROI is basically, as the name suggests, return on investment. Now, whenever a business is set up, suppose Mr. Ghansham started a business with 50 lakh rupees, with some business with 50 lakh rupees in 2020. And after some time, he sees that he is able to generate much more than what he had invested earlier, which was 50 lakh rupees. Let me show you how. So Mr. Ghansham has started a business with a capital of 50 lakh rupees. He either have taken a loan or a bootstrap startup, or it can be anything. That's not the point today. Here the point is he has started his business with the fresh capital of 50 lakh rupees. He has put, or the can it is also called capital infusion. Now, in the amount of 50 lakh rupees was invested in the year 2020. Now, after 2 years, Mr. Ghansham realizes that 50 lakh rupees in just a matter of 2 years have become 1 crore rupees. Now, he also realizes that in just a matter of few years, his capital grew by almost 50 lakh rupees. Now, the reasons can be many. The reasons can be greater sales of goods and services. The reasons can be it can be good goodwill, good equity, and a lot of reasons. But we are not going to discuss about that in this ratio. Since it's only and purely about return on investment, we are going to talk about that. So here we discussed about putting up a business or starting up a business. Not only starting off a business, ROI is a ratio which is calculated by almost everyone if they are investing their money somewhere else, somewhere or the other. Because every financial institution is investing their money, even the companies are somewhere or the other, either in their own companies, either in their own self, or in purchasing extra properties or building up extra assets for the company. So in each of them, what they do is they all expect a certain amount of return on their investment, because all of them wanted that the initial capital infused in the company should grow in a matter of few years, because if it doesn't, it will become a very difficult situation for the company. It can also put a greater amount of losses and debts to the company, which can become very difficult. So, a positive ROI is also a sign for motivation for the entrepreneur to move forward with the business and go forward with the business and scale it up further. So, ROI is very important to analyze either on a yearly basis or a quarterly basis. About it depends purely about the companies, about when they are investing their money. Most of the company are investing their money in every quarters in some other companies, or purchasing, or some merger or acquisitions. Another example, let me share with you, is of a recent merger and acquisition of Reliance Industries with of Hamleys. Now, Hamleys had in now Reliance Industries had acquired Hamleys for quite a big amount, and that amount is a base amount, and which is now doubled, more than doubled about what the initial purchase was. So this is true a return on investment which Reliance Industries is garnishing on investing upon this Hamleys, which is a toy manufacturer based in London. I hope the example is clear. Okay. Now, let me share with you after the, I hope the example is clear. Now, after sharing with you certain examples, now let me share with you a live calculation demo, and let me show you how companies exactly calculate their return on investments with actual figures. So I will share the screen in a moment and let you know how do companies basically start their journey in investing and calculating the return on their investment. Okay, so I'm gonna share my screen. Okay, here's a live calculation of the example of return on investment. We will come on current ratio and gross profit margin, which are also our agendas for this class. But first, we'll start about return on investment as I promised. Now, with a live example, let us see if the net profit, if to calculate the return on investment or an ROI, companies generally follow this particular formula, which is dividing the net profit by the initial investment or the cost of investment, and then multiply it by 100, and then comes their required ratio. Let us try to calculate it. Our net profit here, as per the example, is 100. Our cost of investment is 500, and then we'll multiply it by 100. The answer comes as 100, as 20. So 20 is the return on investment, is at 20%. So this is how companies calculate ROI. Some of the companies, as I told you, calculate it on yearly basis. Some of the companies calculate it on different basis, on different quarterly basis. So the second ratio we have today is, again, the second objective we have is a net profit margin. On net profit margin. Okay. So we'll discuss about net profit margin. So what is this net profit margin? Whenever a company manufactures a particular product or gets or earns a particular profit, net profit margin is a ratio which the companies use to calculate how much amount is the company able to make by selling its products and services after before deducting all the extra expenses and taxes. So this is a kind of a pure profit margin, or which is also companies called, which is also calculated by excluding all the revenues. Suppose a company, I will better explain to you with an example in using the Excel, and if you calculate that, you will get it even clearer. Now let's move on to the Excel sheet. Okay. Now let me share with you again the Excel sheet. Now, as I told you, we were calculating the gross profit margin. Whenever we study gross profit margin, the reason for me to not explaining you before was to first look at the formula and then try to understand the same on your own. So now, as per the formula says revenue minus cost of goods sold. I will explain you COGS in a second, but let's just see the formula. Revenue minus COGS by revenue again into 100. Now let me explain this to you. So basically, gross profit margin is calculated in a simple terms by subtracting the direct expenses. Cost of goods sold is also known as direct expenses from net sales. So if you do not understand revenue minus COGS, you can also write it as net sales minus COGS. And then dividing it by revenue and then multiplying it by 100. Let us calculate what is the gross profit margin as per the example which is given here. Our gross profit margin is 2000. All the figures are in crores. Revenue is 1000. COGS is 1500. Revenue is 1000 again. Net sales is 3000. So as per the formula, I'll again calculate it for you. Net sales is 3000. We are taking the formula as per this to make it even better for you, so that you can get the situation even better. So we'll write the net sales minus what is the COGS or cost of goods sold, 1500. Now we will divide this by revenue, which is 1000, and then we'll multiply it further by 100, and we will put enter. 2985 is the gross profit margin, which simply means that the company is able to make 2,985 for the product or services they are selling. So this is the way how we calculate gross profit margin. Initially, we saw return on investment using that formula. Now we are using gross profit margin. I hope the points are clear. Also, to explain it to you further, net sales is also said as it says, net sales gross revenues minus returns, allowances, or discounts. So basically, net sales is pure sales, like excluding everything from it, with allowances, discounts, whatever product is sold, it is calculated in net sales. The companies do it this way. So we are done with return on investment, ROI. We are done with gross profit margin. Now left is current ratio. Let me again come back to the whiteboard and explain to you. We will start with our third ratio of the day, which is current ratio. So basically, current ratio is, as the name suggests, it is a ratio which calculates the amount which the company can immediately liquidate based on the current situation of the liabilities and the assets that the company has, the current assets or the current liabilities. Current assets which can be immediately converted into cash, or current liabilities can be immediately cleared off. So that is known as current ratio. Now, let me try to explain it to you with an example, but we will better understand this with the help of our Excel sheets or our Excel sheet calculation. So let's go back again to the Excel sheet and then see how do we calculate current ratio. If you do not understand what does the current ratio understand till means till now, so let me explain it to you again. Let me explain it to you in a simple language. Suppose company A has to calculate current ratio on the basis of how much assets they can liquidate on the basis of their current position, or how much cash can be immediately converted into from those assets or liabilities. If we'll explain it to you via examples using the Excel sheet, that will be even clearer to you. Let us go back again to the Excel sheet and let me explain it to you again using the formulas. Okay. So here again, we're talking about current. The third and the final ratio is current ratio. Okay. So as per the current ratio is calculated by dividing the current assets by current liabilities. As I told you in an explanation earlier also, that current ratio is calculated depending upon the situation of current assets and liabilities. Current assets and liabilities decide that how the ratio would be and how liquidable the current position of that particular quarter is. Most of the companies calculate it on a quarterly basis depending on the needs. So let's take with an example of current ratio. Now, as I told you that all these figures are in crores. Now, if as we have taken current assets in our company is 500 crores and the current liabilities in a company is 1000 crores. It's pretty much compared to current liabilities. So 0.5% will be a current ratio, which also decides that 0.5% is the amount only which is liquidable or converted directly into cash if the company wants it, looking at their present status of the quarter of current assets and liabilities. So these were return on investment, current ratio, and gross profit margin. I also, along with the examples, shown you how, along with the live calculation, also shown you how the companies calculate these ratios and how important these ratios are. Generally, also, while talking about current ratio, if the current ratio is in negative, which also means that the liquidation policy, the liquidation status is not positive of that particular quarter of that company. Because the word current also means at present. So at present, how much is the liquidation? So if it's a negative ratio, then it's definitely a bad sign that company cannot get cash from its existing assets or liabilities. It has to borrow external loan from banks or either keep their shares as the pledged for the promoters. That's the last option. But yes, most of the companies do that. And quickly on a revision basis, and we discussed about a return on investment or an ROI, which tells you about how much return is a company able to generate on its net profit and cost of investment, which in our case was 20%. And second is current ratio. I told you about the liquidability position of the company, which in this case is 0.5%, which means 0.5% is the amount which the company can immediately convert into cash based on the assets and the liabilities. And the third and the final ratio we discussed about gross profit margin, which is again a very important ratio, which tells you how much company is able to generate on the basis of the products or services sold, deducting all the extra expenses and other discounts and all as well. So this was my tutorial. I hope you guys know right now till now know about these three important ratios and how these three important ratios are beneficial for your company, for the companies you're going to invest in, for the companies you're going to analyze. So I hope you are clear on the topics. I will see you in the next video with some more important aspects and more important concepts. Till then, keep investing, keep learning, and see you again in another video. Keep using the hashtag finance with Shivam and follow me on www.shivambajaj.in/finance for more information. Thank you so much. Bye bye.